And again, today we're talking about opportunity zones, and we have a special guest, Tony Momini, right? I said it right?
Yep.
He is, well, we met because we were in a CEU roundtable together, and he now does my taxes and tells me all kinds of things that my old CPA didn't tell me about, such as opportunity zones. So I'll let him go into a little bit more detail as credentials, but I just wanted to let you know I have personal experience with him, and he does a really good job. So
all right, well,
that's what I know about Tony. He's great. So I'll let you give more.
well, thanks, Julie. I really appreciate it, and I really appreciate being part of this webinar here today. So first and foremost, I just want to make sure that you guys can all see the shared screen, the shared PowerPoint presentation that I've shared with you. I'm getting a few head nods, which makes me feel good. Admittedly, I'm maybe not the best with technology. So, this is a new endeavor for all of us. So we'll try to make the most of it. If there are any technical issues, if you could go ahead and chat in as part of the presentation, then I'm sure that, one of us can kind of like help you out with that to make sure that not only you get the credit, but also you get the most out of this presentation today. So I am Tony Momini with Capstone CPA Group. This is a little bit about myself. I do have a BBA from Grand Valley State University, as well as a MBA with 15 years of accounting experience. I actually started out in accounting before I graduated college because I knew that that's what I wanted to do. So that's what you do in our industry, I guess. You just go out there and you start working in the real world, which, I find it to be super interesting. And what keeps me coming back every day is that every day seems like I'm doing a different project, usually for small businesses and individuals. So this leads well into the opportunity zones. The opportunity zones were created in December of 2017, which is a long time ago in the tax world. But I guess in the real world, this is a relatively new development. So the opportunity zones, it is a federal program. And so what ended up happening here with a little bit more background is the federal government created this program, and then they worked with these states to designate individual zones within each state. Now, most states actually have opportunity zones within them. And if you're more aware, DHHS within the state of Michigan actually administers things related to these opportunity zones, such as designating what a zone is and fielding questions. So if you have a particularly technical question related to opportunity zones, you can feel free to, not only like click on the links that I've embedded within this presentation, which will bring you actually to the DHHS website within the state of Michigan. But you can also, like if you have investors outside of the state of Michigan that are interested in potentially investing in an opportunity zone, I just want to mention that this is definitely not just a state of Michigan thing. And that will become increasingly important as we go through the presentation, because you'll see at the end that there are some examples of what you can do related to activity with an opportunity zone. And there definitely are opportunities to buy and sell within the opportunity zone. So once you create a fund within the zone, you can buy, sell, trade within that zone as long as you keep a certain percentage of the overall investments within the zone. And as Julie mentioned earlier, if there are questions, I would encourage you to chat in with those questions. Probably what we'll do is hold most of those questions until the very, very end, unless there's like a clarifying question or something like that that we could help to clarify as we're moving through the slide presentation today. So within West Michigan, there are many areas that are that have opportunity zones created within them. In the West Michigan area specifically, there's a fairly good sized area within Grand Rapids. You know, for us anyway, we've gotten the most inquiries related to Grand Rapids and Muskegon. Grand Rapids, the downtown opportunity zone is basically from the just south of the Van Andel Arena, east to Division, then it follows Division south to nearly 28th Street, and then there's a like a 28th Street corridor that is also part of a separate opportunity zone there. So, you know, check into those individually. There's also in Muskegon, there's an opportunity zone that abuts Muskegon Lake, which is kind of a unique opportunity there as well. So we've gotten quite a few inquiries already. So, you know, people are checking into these opportunity zones, and they're at least, I'm going to use the term mildly aware that there is such a thing as an opportunity zone. So that's always a good thing. So here is the general map for the opportunity zones. And so you'll notice, and I don't know if you can see my cursor or not on the screen, but anyway, here's the zone in and around Grand Rapids. As you can see here, you know, that it goes through the main downtown area. This is where it goes south along that corridor of Division, as I mentioned, and then it does head east along 28th Street, nearly all the way to the airport. So, so it's quite a large corridor in the Grand Rapids area, especially for commercial developers. You know, there are some residential opportunities related to this opportunity zone, but usually you're going to be talking about larger investment dollars, as well as, you know, commercial opportunities. So the other thing that is not mentioned within the PowerPoint slide today, so I did want to mention it, is if you decide to create, there's two opportunities within the zone. One is to create what's called an opportunity zone fund. And the other one is to create what's called an opportunity zone business. Now, I'm going to focus today exclusively on the opportunity zone fund. That's it. Because frankly, there's not enough time to talk about what is an opportunity zone business. But there are large opportunities for both, you know, individual and commercial development related to opportunity zone funds and opportunity zone businesses created within the opportunity zone. So, you know, I would encourage you to follow up today's presentation with your own inquiries and looking into, you know, what are the opportunities within and around the opportunity zone fund specifically. And if you want to, if it's piqued your interest and maybe you have some capital gains that you would like to defer personally, you could potentially utilize what's called an opportunity zone business, which is a business created within the opportunity zone. That business, if you sold it off using the holding periods that we're going to talk about today, the same holding periods, the same step up in basis, and the same potential benefits would all apply to that opportunity zone business as well as the opportunity zone fund. And so to kind of like circle back, just from at a high level, an opportunity zone fund would be created primarily to buy pieces of property within the opportunity zone fund, and then, you know, eventually sell off those pieces of property, hopefully for a gain, because that's the entire point of an opportunity zone fund, at a later date. And you would have some potential tax benefits of setting up that type of an arrangement. Okay. All right. So
Can I interject a little bit about the fund?
Yep.
I think from our perspective, one of the big things that goes along with that means that you're buying it through an LLC. You cannot buy it as an individual. So if you're getting a mortgage, you need to make sure that you have a mortgage lender that will lend to an LLC and not an individual. So that's just something to keep in mind there.
Yep, and that's a point well taken. So, you know, in general, if you're going to create an opportunity zone fund, it cannot be as part and parcel to your personal return, or I guess a more human way of saying it is, you have to file a separate business return. So it has to be a partnership, it has to be a corporation, it has to be an S corporation. If it is not one of those things, it is not an opportunity zone fund, period. So there's extra administration that goes along with that, extra costs for setting it up. And we'll get into this a little bit later, but at some point you may be considered to be a fiduciary if you create an opportunity zone fund. So there are multiple layers of administration, and unfortunately we don't have time to go into the individual layers of administration today. But we do have a lot of time to cover, we'll call it the basics of what you should know before you get into these things today. All right. So, I think we probably want to lay a little bit of groundwork here today before we kind of just jump into examples of, when this might work out well. So the background information that you would probably want to know before you get into this is, what is basis, what are capital gains, and what is a step up in basis, okay? So basis in general is what you paid for an investment or a piece of property, less the expenses you have written off, such as depreciation, plus improvements to that either, piece of property or investment, all right? And so, our most common example in real estate that I can think of that kind of covers all of these things would be a rental property. Okay. So you buy a rental property, you spend, I don't know, $250,000 on it. You put some improvements of the property for 30 grand. Now your basis in that property is 280. In 2019, on your personal return, you write off depreciation on that piece of property. That might be about 8 grand or so. So now at the end of 2019, after you write off that 8 grand in depreciation, your adjusted basis in this piece of property that I've fictitiously created would be, about 272,000 for the year. Okay. All right. Then moving on then to capital gains. Capital gains in general are investments, which means inherently they are not business income. Obviously, I could have a 1-hour presentation on what are capital gains, or what gives off capital gains versus business income. But in general, if it is not a business, then we are talking about some sort of investments. That means inherently we're talking about capital gains, all right? And so capital gains then usually equals what you sold the piece of property or thing for, such as a stock, bond, or mutual fund. It is what we sold it for minus the basis, which we went over earlier. And so, you can also take away from that your other sales related expenses, such as your commissions and closing costs. That's why, as tax practitioners, we're always bugging individuals and businesses for those closing docs when when you sell a piece of property, because obviously we know that they don't want to pay more tax than they need to. And so one of the biggest write-offs they're going to get on a property sale or purchase would be the related closing expenditures, okay? So what we do with capital gains, the same as what we do with other income on your return, is we calculate, what it is sold for, less the basis, less the other sales related expenses. Then you apply a tax rate to that, right? So in general, now today in 2020, capital gains, long-term capital gains are either 15% at the federal level or 0%. Okay. Now, I'm not necessarily going to get into a lot of that today with you guys, but in general, if your income is below a certain level, then your tax rate on capital gains, long-term capital gains, would be 0% rather than 15. Most people just call capital gains, meaning long-term capital gains, 15%, but you have to keep in mind there are about half of anybody that's going to sell something that's going to give off a capital gain is going to be taxed at 0% rather than 15. Okay. So for those people who potentially want to get into opportunity zones, the first thing that we would do as tax practitioners is we would determine whether their capital gain rate is 0 or 15%, because it makes a huge difference, right? If they're already taxed at 0, we tell them take the gain. I don't care if you want to get into opportunity zone later or something like that, but take the gain, because I can't predict what's going to happen in 5 years. So if they're going to give you 0 gains, take it all day long, okay? Now, a lot of people also don't talk about short-term capital gains, but I want to park here and talk about those because those are taxed as ordinary income. For most people, ordinary income at the federal level is somewhere between 22 and 24%. For your high income individuals, ordinary income could go as high as 39% for the year. So for high net worth individuals, in general, they want to avoid short-term capital gains. For those people, this opportunity zone might be a much, much better endeavor than people that are getting into or getting out of long-term capital gains where they're quote unquote only saving 15%. Okay. All right. So step up in basis. The step up in basis, when you increase basis, you lower taxable income in a given year, okay, and related to capital gains. And so part of the opportunity zone is a built-in step up in basis if you hold your investment for somewhere between 5 years and 10 years. That determines how much of a step up in basis and therefore how much capital gains you avoid on the overall opportunity zone. Okay. Now, what makes us so excited about the opportunity zone is because my last sort of mark here on this page, which is usually that you only get a step up in basis when you die. And unfortunately, from a tax planning standpoint, death is a great tax planning opportunity. However, it's not a great opportunity for you, but for your heirs. Okay, so I say to people, listen, it's a great, great opportunity, but unfortunately, nobody's ever taken me up on it, on its face value because it leads to a really bad ramification on your personal side. Okay. All right. Okay, so moving on. 3 advantages of using opportunity zones. Okay, so you get to defer capital gains. So in the same exact way that a 1031 exchange just defers the gain, you get the same deferral. You get the same, I guess, deferral opportunity on the face of it. However, there's sort of a gotcha clause in an opportunity zone. This gotcha clause is that right now, the opportunity zones are set to have what's called a mandatory disposal date, okay? So if you, for instance, got into an opportunity zone transaction in 2020, there would be a mandatory disposal date, whether you sold that property or not, and that disposal date would be December 31 of 2026, okay? So on your personal return, you would defer the gain this year on the funds that you put into the opportunity zone. And then on your 2026 return, you would report a very similar type of transaction. However, you would have a step up in basis in our fictitious scenario, which I'll cover in a minute, okay? All right, so the step up in basis is really the reason for the opportunity zone. Okay, in my mind. So what happens is, to the extent that you reinvest capital gains, if you hold the property in the opportunity zone for 5 years, you get a 10% step up in basis. If you hold the property in the opportunity zone for 7 years, you get a 15% step up in basis. And if you hold it in the opportunity zone for 10 years or more, you get a unlimited step up in basis. Okay, so let me repeat that again. If you reinvest your capital gains, you put them into the opportunity zone, you either create a opportunity zone fund yourself and then administer the fund properly, or you buy into an opportunity zone fund that's already been created. After 10 years of holding that investment, 10 years, 1 day, you have zero capital gains on that transaction. Not only do you have zero capital gains related to your initial investment, it would be now related to the hopefully higher value that you sell the property for in 10 years. Okay. So using a very fictitious example, you buy property in the opportunity zone that qualifies for deferral right now for $200,000. You sell it in 10 years for $300,000. You have zero gain, period, end of story. Okay. However, you do have a mandatory distribution date before that date of December 31, 2026. Now, that 2026 date in my fictitious example would be that if you got into this, you got into this arrangement in 2020, you would get a 10% step up in basis for holding that in the property for at least 5 years. So you would show a gain of the initial contribution into the opportunity zone of roughly 90% of your initial investment. And so again, opportunity zones really only work out well for investments that are going to appreciate in value. You don't necessarily get into the opportunity zone just to defer out tax to a longer period of time. You get into the opportunity zone for the opportunity to avoid gain on your gained money, if that makes sense. Okay. Now, I'm sure that there will be multiple questions related to all of what I just spewed out there, but I'm hoping that some of the examples that I'm going to use coming up will really help to like clarify exactly what we're talking about, because I know that this is a particularly, we'll call it like thorny tax pronouncement. In fact, the running joke is within the tax community is that the actual bill itself, I think, was around 12 pages that created this entire opportunity zone. And then the clarification items, the facts from the federal government, are something like 40 pages long. So there are many more questions than answers even today on the opportunity zones in general, and the IRS is trying to like actively manage those questions and expectations as they go along. But anyway, Julie, did you have something to add maybe on this slide so we can clarify some things?
Yeah, I just have that disposal date that is, so it's the sooner of, so like in your example, you wouldn't even be able to hold it 10 years because it's only 6 years until that date, right? So
Correct.
you would get to that point of being able to have unlimited capital gains step up, right?
Yep. So yes, you would. So in a fictitious world where the property appreciates in value, you would have an amount that is permanently excluded. However, it would be in general the difference between what you put in initially, less the 10% of excluded gains that you already were able to recognize, less the amount that you already recognized. Does that make sense? So like the difference is sort of like a triple net amount. So like in my fictitious example that I created, right, where you put in $200,000 into the opportunity zone, okay, you would have to pay something like 90% of your capital gains on or around April 15th of 2027 for the 2016 tax year. And then when you sold out of the investment after 10 years, using my fictitious example, it was worth $300,000. You would have excluded gain of $100,000 permanently excluded. And then you would have something like 10% of the initial capital gains that you avoided that were also excluded. Okay. And so like, I just want to like, again, highlight that fact. There is going to be a mandatory disposal date that is earlier then the date for which you're probably going to be able to get out of or want to get out of this opportunity. Okay. Now, what's interesting, and I think this is what's going to happen from a practical application standpoint. A lot of people are going to dump their investment on or around December 31 of 2026 if there is no appreciation of the property.
Yeah, that makes sense.
Yeah.
So,
Okay.
one other, maybe, I don't know, clarifying question. If I have a property in an opportunity zone that I want to buy, and I
Yep.
just want that, and I know I'm going to keep it for 10 years, so I just want to exclude the gains on that property. Do I have to roll something over in order to buy that in an opportunity zone way, or can I just put cash in?
Great question. So this is one thing that is buried in the code, but it should have been the first point, I think, and for everybody that we talk to, it's usually one of the first pointers that we try to point out. Right now, the way that this entire like code section is written up, it says that in order to participate in the opportunity zone, so in order to participate in a fund, you must have capital gains that you are deferring. Period. So you could potentially defer some collective of capital gains and then just put in additional cash. I mean, I could give you a fictitious example that would actually pass muster, okay? You buy Apple stock today, okay? You wait 3 days until there's capital gains. You sell out of Apple. Now you have capital gains. Now you can take that money and participate in the opportunity zone, but you could also put up your own cash that could otherwise qualify, I believe, for potential, we'll call it like sheltering of the tax later on, of your overall investment. Okay. Now they do have in Congress right now, there is a bill that would, I'm going to call it, fix the problem that they're having, which is the problem they're having is the very one that you brought up, Julie. Like, how do we get people to bring cash, right? And so they're drawing up right now a fix to this problem. But, frankly, it seems like that there's more important things on the congressional docket that are like up for discussion right now. So I'm hoping that there is a fix for not only this drop dead deadline of December 31 of 2026, which, by the way, was not their intent when they rolled the bill out, but also for, we'll call it the potential deferral of cash transactions brought into an opportunity zone fund. Okay. All right. All right, so let's move on then to comparing the opportunity zone with a 1031 exchange. And I think we already kind of like glossed over some of these, but we want to make sure we hammer it on home for you guys so that you're comfortable with like the general nuts and bolts of what you're getting into, right? So to compare and contrast it with a 1031 exchange, it is the same as a 1031 exchange in that you get to defer the gain so that income is not taxable now. Okay, so I think all of you guys are, you're familiar with real estate transactions, so you know a lot about the 1031 exchange. So what is different about the opportunity zone fund but good? Okay, so what is good compared to a 1031 exchange is that you definitely qualify for step up in basis for the opportunity, for the funds that you put into the opportunity zone. Okay. The other good part is, and this is, I sort of feel like maybe this is splitting hairs at some point. Okay. And maybe Julie could clarify this point a little bit more, but my understanding of a 1031 exchange is that within 45 days, you have to sort of release a matrix, right? Where you tell all of the properties that you're potentially looking at in order to participate within a 1031 exchange, right? And then within 180 days, you must execute a purchase in order to bring it on home, for lack of a better term, for the 1031 exchange, right? Now, To compare and contrast that with the opportunity zone, you have within the opportunity zone, you have a true 180-day replacement date. So you don't have to necessarily like release a matrix with every single property in every opportunity zone across the country, but you do have to, within 180 days of when you sell out of something, you have to replace it with something else in order to qualify for the opportunity zone. So one of the things that we've gotten clarification on related to this is, once you have an opportunity zone fund, do you have the same 180-day replacement window if you sell out of a property after the fund has already been created? And the answer is yes. So for instance, you sell out of property, like your regular old property that's not in an opportunity zone in 2020. You buy a replacement piece of property to participate in an opportunity zone fund in 2020, okay, deferring the gain in this situation. Then in 2022, you say, listen, I want to get out of this and get into something else that's also in an opportunity zone, but it's in an opportunity zone, maybe in another state, or it's in another location. Shoot, it could be the spot right next door, right? So you sell out of property B, and then you purchase property C. As long as property C is as much or more than property B, then you are good. Or as long as your collective of all of your properties within the zone are at least as much or more than property B to start with, then you're good, okay? And so again, we're not gonna like park here too long because we do have some really good examples, I hope, to get to here in a couple minutes. So we'll keep powering on, all right? And then here's another thing that I did wanna mention, okay? You can change your property type. So as you guys are probably already aware of, the 1031 exchange is very prohibitive related to changing types of property that you would like to get in and out of, okay? And so, you know, in the recent past, I've had other clients that have actually participated in 1031 exchanges related to buying and selling stocks. They've actually closed that when in the Tax Cuts and Jobs Act of 2018. So you can no longer participate in a 1031 exchange related to stocks, bonds, and mutual funds trading, okay? Prior to that, you could. So that was one thing that was always in our kit bag, okay? Hey, you want to participate in 1031 exchange? It's not, you know, it's not your normal real estate exchange, but you could potentially do this within the same similar industry from a small business or a large business standpoint. You can get in and out of this stock for that stock, and federal government says it's allowable. Now that they've sewn up that loophole, the only way that I'm aware of that you can change property types, such as going from rental real estate to commercial real estate, or going from, we'll call it like land, to a full-on built-out rental, would be to use an opportunity zone in order to defer the gain, okay? Now, for all that is good, there are definitely some bad, right? So, as we already mentioned, you're required to recognize the gain on a set date, whether the asset is sold or not, okay? So that provides a lot of problems in the real world, such as, how am I going to pay for this capital gain tax that I'm going to get? And so, you know, that's something that your investors are definitely going to have to figure out, or if you're looking into this yourself personally, you're going to have to figure that out. You know, it is a set date, and unless the IRS or unless the federal government comes through and we'll call it like fixes the problem that they created, because they didn't necessarily want to give out like a $2 trillion benefit for this opportunity zone. They wanted to be able to show Congress that they had some sort of recapture at the time of writing this particular bill. That's why they wrote it in there. But they also wrote in an addendum that says, P.S., we're looking to fix this permanently. We're working on it right now. I mean, even at the writing of the bill in 2017. What makes people uncomfortable is it's now 2020 and it's still not fixed. Okay. All right. And so my point two, which we already covered, is you must have capital gain in order to enter into the opportunity zone. Okay. So it is mandatory, not a question of can you just put up your own cash. All right. And the other thing that is the downfall, which I covered really quickly earlier, but I want to make sure that everybody is aware of, is that usually you must have an opportunity zone fund. I use that term usually because you must either have a business that you create within the opportunity zone, or you must have an opportunity zone fund. Those are the two ways to participate in the opportunity zone. So those are the only two ways to participate, in the universe of participation. Okay. The other thing that I will mention is this is a recognized tax shelter, opportunity zone and opportunity zone funds, therefore. But tax shelters usually have a very negative connotation. But this is a IRS recognized tax shelter. So anyway, I did want to mention that only because I'm a tax nerd and there's very few times where we get to, I guess, potentially put a stamp of approval on a recognized tax shelter that is recognized and approved by the IRS. Okay. All right. So without further ado, we got example one. Okay. So in example one, owner sells rental house and buys replacement property in the opportunity zone and creates an opportunity zone fund. Okay. Boy, that's a lot of words. All right. So we'll try to power on through it. I know that probably at the end of this presentation, we'll have some questions and we'll try to get to those. So make sure that you are, kind of like chatting those in on the chat box. I will also have, my contact information. I'll make sure that I make it available for you guys in case we start running low on time. But it looks like we're actually doing pretty well so far. So, okay. So this individual sells as residential rental for $375 in 2020. This avoids capital gain this year of $150,000, right? So assuming that this person had long-term capital gains of $150,000, that's quite a lot of money for them, And so they said, hey, we would like to take advantage of this opportunity zone. How can we do it? And we say to them, well, you could buy into an existing fund, which there are existing funds out there. There are existing funds that literally just invest in West Michigan as well. So we encourage you to reach out to those people. If this is like scaring you from creating your own fund, for instance. However, if you're still interested in creating your own fund, you could create a partnership. That would be the easiest one. You could create a corporation, or you could create an S corporation. All of those are things or entities that are available to create your own opportunity zone fund. Okay, so this individual just said, hey, I'm not afraid. I know what I'm doing. I can keep track of things. I've got great attorneys that can help me to set up the business entity itself. And so I'm going to create my own fund. So this person creates their own fund, buys a commercial rental property for $400,000 within the 180-day of the initial sale of the residential rental. Okay, and so this individual now has to operate the fund. So, in this fictitious scenario, they created the fund themselves. So they have to operate the fund as normal during the holding period. And, they're going to enjoy some lower taxation and potentially some great lower taxation, as we can see maybe in the next exam, or one of the next examples uses vacant land as a replacement piece of property. So if you'll notice here, I have specifically chosen a type of transaction that would not qualify under 1031 exchange. Okay, and I've done that on purpose because I want to show you guys, I guess we'll call it the opportunity to participate with the Opportunity Zone Fund. If this was just a 1031 exchange, they would have had to have found a residential rental property You know, so there are, again, limitations, but there are potential benefits in being able to swap out the types of properties that you would like to participate in as an investor. Okay. All right. So in example 2, owner sells vacant land, buys replacement property in the OZ. Okay. So sells the vacant land, and it's, in this case, it's commercial land for $515,000, avoids $200,000 of gain this year, creates their own fund again with all the related layers of administration of doing that. Okay. The fund buys 2 residential rental properties for $535,000 after closing costs within 180 days of the initial sale. Okay. The other thing that we could do here is we could add another twist, right? So that's what I kind of want to do just for a talking point. So let's say that you'd go through all of the, we'll call it all the headaches of creating your own opportunity zone fund. The real opportunity for this is to potentially bring in some investors. Okay. So once you've done all the legwork of creating the opportunity zone fund yourself and funding the fund, and you know that you've got all this administration for at least the next 10 years, it might behoove you to take your $500,000 that you took over here and find somebody else with $500,000 that wants to invest. Okay. Now, there probably are restrictions of, you know, when they could get out of their investment, for instance, that would be baked into the operating agreement. However, well, and that would be to protect yourself as the manager of the funds and the manager of the property. But, you know, this could be an opportunity for, you know, an individual that really wants to get into, we'll call it like real estate investment. And specifically within, you know, within West Michigan, in my fictitious case, that I created, and or you know, really wants to partner up with, you know, larger, we'll call it like larger cap value investors, but doesn't have that access to capital right now. I mean, if we talk about who is looking for opportunity zone fund investment opportunities, it's people with a lot of money, or it's people with short-term capital gains. Which kind of makes sense if you kind of like do the math on one of these. In order for it to make sense, you've got to have, like, in my opinion, you have to have at least, you know, $200,000 or $300,000 of capital gains that you're trying to shelter, or it has to be short-term capital gains. If it doesn't, the extra administration is just going to eat up the, we'll call it the opportunity cost, if you will. Okay, so you either have to have large investments yourself, or you have to be able to attract other investors. Okay. All right. And then, of course, as before, the fund operates as normal during the holding period. Okay. All right. So in this example, this fictitious example, we're comparing and contrasting a 1031 exchange with an opportunity zone fund transaction. Okay, so we'll start with the opportunity zone fund because we're already having fun with that. We might as well keep on rocking, right? So this will look very similar because so far it's the exact same set of circumstances as example 2. Okay, so in example 2, the person sold vacant commercial land for $515,000, avoided capital gains of $200,000. The fund now buys 2 residential rental properties for $535,000 after closing costs within 180 days of the initial sale, right? Thereby deferring the gain now, and, you know, they would have to, you know, like obviously operate as normal during the holding period. They would have the same, you know, mandatory distribution date of December 31, 2026, et cetera, et cetera. Okay. All right, so this is example 3 continued. Now we're going to compare and contrast that to a 1031 exchange, right? So sells the vacant land for $515,000, tries to buy 2 residential rentals to replace, cannot because it is dissimilar property type. Okay, so either the person did do this didn't get good advice and now has a capital gain of $200,000 when the IRS audits their return, okay? Or if they were working with people that knew what they were doing, they would say to this person, listen, you really can't do this. You can't buy this type of property after selling the other type of property. So in order to avoid the $200,000 in capital gain, you must buy vacant commercial land in this fictitious scenario, or just pay the piper, right? Pay the IRS. You know, in this case, if it's long-term capital gains, it should be, you know, somewhere around 15% of the 200,000. And so, you know, the other point that I did want to kind of park on here was in the 1031 exchange. If you remember, the person does not have to create a separate legal entity in order to participate in the exchange. So it is definitely one of the benefits of entering into 1031 versus, you know, a opportunity zone. Okay. All right. So moving on, I believe this is our final example. Okay. But I did kind of want to lay this one out here. All right. So owner sells family-owned business and they sell the stock. Now, it's super important from a tax perspective that they sell the stock in this example, because the selling of the stock is the only thing that would give off capital gains. If, for instance, they sold out the business and the sale was other than a stock sale, they would not have capital gains in this fictitious scenario in most instances. So they would not be able to avoid the capital gains. Okay, so in this example, they sell out a closely held business, you know, a family business for $750,000. They have capital gains on this transaction of $550,000, right? Okay, so that's going to be a nice round number that the IRS and the state of Michigan and the city of Grand Rapids would potentially be, you know, asking for on the payment side, right? So this person decides, hey, I want to get into the opportunity zone, and they said, hey, rather than creating an opportunity zone business, I'm going to create an opportunity zone fund. So they go out and they find 3 properties within the opportunity zone for $800,000 after closing costs. They execute those set of replacement purchases within the 180-day testing period. And so everything's good. They've got their I's dotted and their T's crossed. They're feeling really good, and, you know, avoiding a very large tax bill in 2020. Okay. All right. So let me see. Now, the last part of this example that I wanted to park on, or kind of like review with you guys, is I mentioned earlier that once you create an opportunity zone fund, you can buy, sell, and reinvest within the opportunity zone, seemingly unferreted, as long as you stay within a opportunity zone. Okay, so said a different way, once you create the zone fund, and once you hit the initial markers of 180 days of initial sale, if you wanted to sell one property in this example, because the person has 3 properties, if you wanted to sell one of them and then replace it with another piece of property within the zone, as long as you didn't take cash as part of that sale, you know, or, well, I guess what's generally called boot from the IRS. I don't want to necessarily go into that, but generally it's cash. Okay, if you take cash as part of the transaction, then you would have some gain, and, you know, you might not be able to actually continue to operate the fund, by the way, if you did take those gains out as cash and not reinvest them within the reinvestment period. But in this example, to stay on point, if you didn't like the 3rd property that you purchased within the fund, it was like it didn't turn out the way that you wanted or something like that, sell the thing out, replace it with another piece of property within some opportunity zone area. Within 180 days, you're good to go. Okay, and it doesn't even need to be in the state of Michigan. I mean, that's the other point that I wanted to make with you guys. If you get into the opportunity zone fund, you can participate in any opportunity zone in the United States unferreted. Okay, so you don't have to stay in Michigan. If you want to get something out in California, for instance, or I don't know, some other state, hey, you can do that. And so, you know, it just comes down to your appetite for risk, I guess, at some point. Okay. All right. So I think we're actually looking pretty good on time for once in my world anyway. So
We
I
got
feel
five
pretty good
minutes.
about that.
We got 5 minutes. So I have a couple questions that
Sure.
came across on the chat.
Yep.
What income level qualifies for the 0% capital gains? I assume that's like the lowest one, right? Do you know what that is?
As far as like long-term capital gains, I assume that's the question. Yes. So if you are, if you're single individual or married filing joint, it would be if you're in the 22% tax bracket or below, then you get 0% capital gains. Okay. So
That's pretty low.
it's actually it's a fairly nice exclusion because most people will qualify for at least like some amount of zero capital gains. And what they do is they actually prorate it as well, which is a very, very taxpayer friendly way to calculate it. So what they do is they say, listen, before your capital gains, how much room did you have to grow within the 22% bracket? So if you had, I don't know, $35,000 in order to like move through this bracket, so to speak, you get 0% at 35 grand. It's a pretty nice exclusion amount, and frankly, I haven't found someone yet that's really got hurt badly by how they wrote up the code related to 0% long-term capital gains. So anyway.
Cool.
Yeah.
Okay, another question. In a partnership, like if you do get more investors,
Yep.
you gave that example of trying to bring in more, does that have to be deferred gain, or can you just say, hey, investor, I have an opportunity zone, I have deferred gain that's in it. If you just want to give me some cash, then we can protect our capital gains on this property that we're buying.
I believe the testing is at the investor level. So the answer to that is yes, the investors must be deferring an amount of capital gains.
Okay, but once you're deferring a little bit, you can put in additional cash over.
I believe that is true, yes. Yeah,
Okay.
because they don't want to discourage people bringing cash as well to the table. In fact, that's kind of like half of the whole point, right? Is to like get people to invest in these things. So, I mean, what they're trying to do as part of this, we'll call it the bill to correct some of this stuff. What they're doing is they're trying to like eliminate the capital gains requirement in totality, and then they're trying to also fix some of the definitions of what they intended initially that didn't necessarily come out the right way in order to get the bill passed. So.
Okay, and then when you buy a property, let's say I have 100,000 worth of gains that I'm trying to defer, and I buy a property for 50 that needs 50,000 worth of repairs. Does that qualify, or does it all have to be like a 1031? It has to be the property. And if I pull out cash to do repairs, I just screwed it up, at least on that cash. But that's not true in this case because it's all in the fund, right?
Correct. Yes. I mean, that's also one of the things that makes like, and I don't want to get into it because I don't necessarily want to lead somebody down the road of like getting in trouble with one of these funds, because frankly, if you get in trouble with one of these funds, it's kind of like all or nothing, right? I mean, if the IRS comes in and audits you, and it's determined that you like, you skirted the rules, so to speak, or what have you like that, then nobody gets any of the opportunity for deferred gain. So to answer your question, yes. I mean, there are opportunities for a person to invest in things like improvements in a property. In fact, when you get into one of these opportunity zone funds, if you have a certain type of property, it might be a requirement that you improve the property by this percentage before you can even participate as an opportunity zone fund. So, I mean, there are many requirements, and so many, in fact, that I can't necessarily cover them in 1 hour. if you guys are definitely looking at opportunity zones, I just kind of wanted to, at a very high level, just talk to you about, the immediate things that are opportunities and the immediate things that are going to corrupt your ability to really do them. But there are additional requirements, additional things that could corrupt your ability to be in and participate in the opportunity zone. And so, yeah, in a lot of scenarios, the initial purchase of the property is only about somewhere between 50 and 70% of the overall outlay that you're going to need to make within the opportunity zone. So they're actually requiring that you put additional improvements to properties depending on what type of a property it is. You can't just buy vacant land, for instance, and just park on it. That is not something that's going to work out well for you.
Hello.
Okay.
I just wanted to quick say it is 11:30. Molly, do you have everybody for Con Ed? Do you have, so if you need to go, I understand. Tony, if you have a couple minutes for a couple more questions, there is a couple in the chat yet. Besides you kind of mentioned the cost, like the cost of administering the Opportunity Zone Fund versus, if you just did a 1031 in your own name. Besides just doing a tax return every year, what else would be involved with that?
So hold on just one second. I'm sorry. I'm replying to another chat here a second. So beyond the what would you call it? The price of getting in, right? So beyond creating a partnership return, it's the administration part that's really going to hurt people. And so the thing that I would compare this to, I would compare it to like a living trust. Okay. So if anybody has had to do a trust administration in the past for a family member or something like that, trusts are super easy to create, but they're fairly hard to administer in a lot of scenarios. And they take a lot of time, a lot of like tedious, we'll call it like tedious bookkeeping, tedious details. You must communicate to all the individuals that are participating in the trust. There may be certain, we'll call it like filing requirements as a fiduciary for the people that are investing within, or not, well, I use the term wrong because, I'm saying investing in the Opportunity Zone Fund in this case, but for the individual, like we'll call it recipients of the trust funds, you do have to provide an accounting, for instance. You have to provide, certain documentation to prove that you're at least 85%, invested within an Opportunity Zone area. All of these would be filing requirements, and I believe that the same fiduciary standards that apply to a trust also would apply for an Opportunity Zone Fund. So you're not just getting into like, hey, let's buy a cottage and let's just split the cost of the mortgage, right? There's a lot more. I mean, you got to file a tax return for that partnership now, or somebody does. The person who's investing with you could ask at any time for any reason for an accounting. I think going back to the inception of the accounting records, because you're a fiduciary, for this fund, and there's certain filing requirements that you have as an individual investor that are different than if you just get into what I would call like a casual relationship. And so, when you start getting into the minutia of what you have to do, that's when it should kind of like, I'm going to use the term, it should scare people, because it really is. And there are a lot of very high level, and sometimes potentially scary requirements that would be exacted upon a person that is creating a fund and managing the fund's assets. And if you want to think of it this way, the way that I would think of it is either the same level or very similar level to, creating and establishing and maintaining a trust or an estate. Or, for people that are familiar with like investment funds, you're like a fund manager now for this investment. So, just kind of keep that in mind. At some point, it's not worth the headache, especially if you don't have a lot of money to defer,
Mm-hmm. We have one question about how to find opportunity zone properties. I think
Yep.
key there is the opportunities. I mean, just to refer to the map and then whatever's
Yep.
for sale in that. So Jenny, and everybody who has that same question, I'll put a link to the map in that Clarity Conversations. That's probably the best. You can really drill down into to a good level of detail to know that you are in that zone.
Yeah, I mean, you can go like if you're familiar with like Google Maps or something like that, you can go street level. I mean, it's pretty in depth. How in depth you can get on this whole thing. So, I believe you can also search by address. So if you think that it's within the zone based upon the map, but you definitely want to make sure before you purchase it, you would cross-reference it with a street search, and then you would know 100% certain.
Okay. Yeah, rural development works like that for us too. So
Yep.
I think that's all the questions that were on the chat. And I know we're over time by a few minutes. So unless anybody has anything else, I guess we'll just say thanks, Tony, for spending your morning with us.
Yeah, thank you. Yeah, next time I'll have to, after COVID, we'll have to do the whole lunch thing. So at least I get a free lunch out of it, right?
That's right.
So